Welcome to Moffat on Money. I'm Clay Moffat and glad to be here with you today. We're doing something a little bit different. We're actually responding to a specific subscriber request. Our first, which I kind of think is cool as hell. So, Quad E and some numbers. This video is for you and anybody else interested in better understanding what is a recession, what's a depression, kind of how does it impact you or the economy as a whole. I also want to let you know that our next video is going to be on the Twitter 8. I hope to have it done in the next couple days. The Twitter 8, you may not be familiar with them, but just the other day, Friday, 8 individuals, significant quote unquote social influencers, were arrested and charged by the SEC with securities fraud. They were running pretty much what's called a pump and dump scheme. So we'll look at what they were doing, how they were doing it, how people maybe could have understood or prevented being part of that. One of the 8 was, they had a little Discord channel going, and one of the 8 was actually quoted on the Discord channel as saying, "We're robbing effing idiots." That's probably going to be the title of the video. So stay tuned. The goal of this channel is to try to help you better understand investing, what to do, what not to do. Again, I don't ever recommend or deal in specific securities. I'm not here as a registered investment advisor to advise you personally to buy this stock, sell this stock. I receive nothing from any securities, investments, insurance, financial firm, on down the line, for anything I say or do on this channel. The goal is just to try to help you become a better investor, understand the markets and the economy at large a little better. So if you like the idea, hit the like button, hit the subscribe button, and help us keep the channel growing. So recession and depression. Both of these are descriptions of the economy, relatively poor economy, but to varying degrees. Now, economists and historians have tried for decades to explain what's a recession, what's a depression, but generally get lost in the weeds a lot of time, or they say something that's so vague or general that it's not really a whole lot of help. So hopefully we can contribute to a better understanding of that today. That's the goal. Now, economist, and even though my PhD's in finance, it's a subset of economics in general. So I'm kind of technically an economist. And economists, unlike CPAs, all my CPA friends are not going to appreciate this too much, but we have jokes. They don't have jokes. So kind of a pithy little quote in terms of understanding the difference between a depression and a recession. A lot of people will often describe it as, if my neighbor loses his job, that's a recession. If I lose my job, that's a depression. Now, there have been some other, cute little, I say cute, talking about people losing their jobs is not necessarily cute. But for example, the Atlanta Constitution in 1938 came up with, a depression is when wages are cut so low, no one makes enough to live on. And a recession is when the price of everything goes up so high, no one makes enough to live on. Sounds kind of familiar almost to today's situation, doesn't it? Some other quotes, 1937, obviously the 30s were, depression was a topic of discussion. Lima Bean thinks the only difference between a recession and a depression is that one is a let up and the other is a let down. I mean, there's some truth into that. The Ephraim Utah paper in 1949 stated, I've already learned the difference between a recession, a depression, and a panic. A recession is when you tighten your belt. A depression is when you haven't any belt to tighten. And a panic is when you've lost your pants. So, while somewhat amusing, the jokes are funny because they contain some truth. And truth is always funnier than fiction. So ultimately, the two terms, recession, depression, are used to describe the growth or shrinkage, actually, the shrinkage in the economy. Now, economists historically have defined a recession as two successive quarters of negative GDP growth. Negative GDP growth. That just means the economy shrunk. Now, when I say GDP, I'm talking about the gross domestic product. Gross domestic product is just simply the market value of all goods and services produced in the US. And the number is calculated or determined by government statisticians once a quarter. So when we talk about GDP, we're really talking about that number. Now, there are official definitions of recession and depression. The government bureau who actually officially declares a recession or depression is the National Bureau of Economic Research. Most people call it NBER. NBER. Now, they define a recession as characterized by certain standards: high unemployment. In a recession, employment rates rise as companies lay off workers due to demand for their products shrinking or stalling. Companies need a growing economy to keep producing, to keep increasing production, to hire more people, to expand their plants, that kind of thing. So in a recession, when people start buying less, it causes companies to produce less, which increases layoffs, or generates layoffs. I guess I should say a little bit more accurately. In a recession, you'll see falling home prices. Obviously, there are people who are losing their jobs or suffering wage cuts who are unable to buy or increase the size of their house like they would kind of in a normal market. Buyers have less money and are even more cautious about making large purchases due to the uncertainty of the economy and their jobs. Maybe they fear losing their jobs, so they're not willing to go out and commit to a big expense. You'll see stock market declines in a recession. Obviously, as company earnings fall, investors, when you invest, you want a company that is making money and is increasing making money. I kind of laugh when some people complain about company profits hitting all-time highs. Well, do you want to invest in a company that makes less money this year than what they made last year? No. You want every year to be record profits. Ideally, those are the kind of companies you want to invest in. So I always kind of laugh when somebody says that's a bad thing. That's not a bad thing. That's what you should be looking for. That's the goal. Another characteristic that NBR defines or uses, standard that they use to define a recession, is stagnant or decreasing wages. Now, these are called real wages. When we talk about real GDP or real wages, what we're basically doing is adjusting that number for inflation. For example, if you get a 2% increase in your pay, but inflation is 2%, your real increase is zero because you've just kept up with inflation. If inflation is 5% and you get a 2% increase, your real wage growth is minus 3%. And so far, past couple of years, we've had 20 consecutive months of negative real wage growth. So that's where inflation really starts biting the worker, particularly the low and the middle class. Inflation just slams them. Many people are having to, adjust the way they buy food and eat. So inflation really hurts more the middle class and the lower class. And then obviously negative GDP. As I mentioned previously, economists traditionally have considered a recession when you have 2 quarters of negative GDP growth. Now, we had that the first and second quarter. This last third quarter GDP number was positive. And a lot of people are like, no recession. Well, you always need to look at what goes into that bottom line number. I personally, and I'll probably say this many times if you know me for long, I hate people who say they're bottom line people, because a blind pig in a poke can read the bottom line. Your advantage comes from knowing how to change that bottom line, or what goes into that bottom line. That's really what ends up impacting you as an investor and gives you advantages or insights into what is coming down the road. And as an investor, that's really what you want to be focused on. You want to be focused on what the trends are and what is going to happen. So you're trying to look at the numbers and see what they imply as far as the future. So if you look at the third quarter GDP, which is positive, there's really only one category out of all the different economic categories, out of all the different contributions to the national production, the GDP, there was only one that was strongly positive, and that was trade, particularly exports. And so if you narrow down and look at that number was positive solely because of giving billions and billions in cash and weapons to Ukraine. So the US government gives Ukraine cash, that's an export. The government pulls tanks and rockets out of inventory, gives them to Ukraine, that's an export. Nothing was manufactured. No jobs were created out of that. But technically, that's an export. So it boosted GDP to positive. Does that mean that the economy as a whole is recovering? No. Does that mean wages are recovering? No. Does that mean jobs are increasing? No. So you've really got to look beneath some of these numbers to try to understand, is this really good news or is this just a deflection? Now, depressions, the NBER characterizes depressions by skyrocketing unemployment. High unemployment, recession, skyrocketing unemployment, depression. If you look at the Great Depression, unemployment reached 25%. 25% of the working population was unemployed. So 1 in 4 available workers was unemployed, couldn't find a job. You've got plummeting wages because so many people are being laid off. Even people that work are oftentimes working fewer hours, so their wages drop. They're significantly less. Wages during the Great Depression fell about 43% between 1929 and 1933. So imagine over the next 5 years, you're going to be earning 50% of what you do now. Depressions are also characterized by significant declines in GDP. GDP during 29 and 33 fell about 33%. So 1/3 of the nation's economy just vaporized. That's pretty significant. So recessions are not as severe as depressions, and they last a shorter period of time. Normally, recessions will last 6 months to 18 months to 2 years, somewhere around there. Depression, now that's a little vague. I'm actually having a question raised at this moment. Yes, ma'am.
Dr. Moffat, I heard yesterday that there isn't actually a recession unless the president declares a recession.
Interesting question. Just in case you didn't hear it, is there actually a recession until the president declares a recession? And the president doesn't actually officially declare a recession. That's the National Bureau of Economic Research. Now, my comment, I guess, would be official or not. Is the sky blue if the president doesn't say the sky is blue? There's a certain reality.
It depends on who you ask.
And economists have been historically very clear. Recession is 2 quarters of negative GDP growth. So, yeah, I don't often get pop-ins while I'm filming, but Hey, I enjoy questions. I do. Now, looking at the official NBR detail and all that, their explanation to me is a little vague. So let me give you some roughly ballpark metrics. And I mean, these are ballpark. I am not the official one declaring depression, recession, but I can give you some things that'll give you a little bit better intuition or feel for the differences. There have been 23 recessions since 1900. There's been one Great Depression. Now, in a recession, like we said, the economy slows down, joblessness increases, unemployment increases. You've got a drop in corporate earnings, that, causing the stock market to drop. It's hard to find a new job, and most people are reluctant to start a new business. So you see Americans eating cheaper meals. There'll be companies like McDonald's and Walmart that pick up business that actually do better in a recession. People forego expensive vacations. College grads maybe start moving in with their parents, called the boomerang generation. But as far as metrics, you'll look at unemployment hitting 6% or more. You'll see a decline in real household wages. You'll see slowing consumer expenditures. You'll probably see in this day and age, you'll see consumer credit card debt racking up, increasing because they don't have the money to afford food and the basics. So they have to use their credit cards to buy it. And again, GDP declines for 2 or more quarters. Contrast that to a depression. Now, depressions kick off with a recession, but they end up much more destructive. They'll extend past 2 years. The effects continue to worsen for several years. GDP may shrink by 8 or 10% or more. For example, it shrank by nearly 13% in 1932 in the Great Depression. Unemployment goes above 15% and remains high. As I already mentioned, it reached 25% in the Great Depression. And stocks are slammed for years. Now, let me show you a couple of pictures to help demonstrate some things. This is looking at GDP. Now, here to the left, 2734, you can see the drop in GDP with the Great Depression. And it increased some here in 34, 35, but keep in mind, it had dropped so low that this kind of is a little bit of a distortion. And then it drops again right before the war. Obviously, in the war, it took off. Now you see this sharp decline. That's, can I say that's due to technical factors? Because all of a sudden you had all these troops coming back home who were producing nothing, who didn't have jobs yet. A lot of the heavy industry that had been manufacturing war goods, tanks, etc., all of a sudden stopped and had to retool to produce cars and whatever. So most economists don't really consider this to be, another depression. It's just kind of a technical thing. So if you go on from, 47 and on, you can tell there are a few little times, like here in 81, 82, there was a recession. Here in the subprime crisis, 207, 208, 209, there was a recession. And then obviously the COVID effects, particularly the lockdown effects that the country went through. So this is just kind of a highlighting, some of the prior little recessions. We had a real brief recession here in 91, 92. So that may give you a kind of a sense of the scale between a recession and a depression. Now, if I look at this is the Dow Jones during the Great Depression. And you can see it drop from about 360 down to 45-ish. But what I want you to know, here's, the Black Thursday, the severe drop. There were times when it rose. and then it dropped, and then it rose, dropped, rose. These periods of brief increases, I refer to them as a dead cat bounce. When you were a kid and you found a dead cat, and it was kind of blown up. Did you ever take it maybe and bounce it a little? Well, anyway. But these are known as dead cat bounces, and they don't indicate that the stock market decline is over, but they are perfectly normal in a declining market. So you've got to keep that in mind, particularly as we've seen our market currently bounce. There are all sorts of different reasons why, and we won't go into that today, but just keep in mind, just because the market has a few good days or week doesn't mean that the decline is over. Now, if I look at the Dow Jones over the period 25 to 55, obviously you can see it peaking here and the drop through 33, 34 during the Great Depression. It did start going up, some went down. But the thing I really wanted you to know is here it's about 360, which it took almost 25 years to get back to that point. And that's how devastating a depression can be in terms of the market. Now, when I'm, as an investor, as a portfolio manager, whatever, my main concern is capital preservation. I can't time perfectly all these little fluctuations in the market, so I don't try to do that. I will normally stay invested. But what I try to do is avoid these huge downturns. Like right now, I'm in cash because I think there's a pretty strong recession, coming up. I can't time it perfectly, so, I'm on the sidelines. But my goal is to avoid those big declines. And then when I think, we're somewhere near the bottom, I'll go all in. That's just my philosophy. But to me, that's what the advantage of good information is being able to make better decisions. So that gives you hopefully a little bit better feel of what I mean when I talk about stocks are slammed for years, huge sustained losses in a depression. Now, what causes a recession? Can be any number of causes. Some common ones are high interest rates. The Federal Reserve obviously controls interest rates. And as we've talked about before, interest rates are the price of money. So the Federal Reserve is saying money has been too cheap, too easy, too available. And so let's raise the price of it. That effectively lowers the supply because there are few people wanting loans. We already talked about how bank loans work to increase the money supply. So raising the interest rates makes money more scarce. Stock market crashes. The Great Depression was brought about by a stock market crash and people panicking. When the stock market starts falling, oftentimes people panic and they don't know what's causing it. So they go ahead and call up their broker and say, sell, sell, sell. And so the broker sells. Other people see the market continuing to fall. They start getting anxious and excited. They'll call their broker and they'll start selling. So a lot of times the selling can feed on itself. So the market falls quickly. It rises slowly. So you need to keep that in mind. A stock market crash can cause loss of billions and billions in capital and life savings and put a real damper on the economy. Falling housing prices, puncturing of a housing bubble like we saw in the subprime crisis in 2007 and 8 and 9. That caused a recession. It was a credit crunch, so to speak. Wage price controls, that's one main factor in the Great Depression that helped contribute to the dying economy. So there can be a number of causes or factors in creating or kicking off a recession. Now, I just kind of alluded to one of the contributors to the Great Depression. I get asked a lot, what really caused the Great Depression? Got to start off with saying speculation in the stock market. money was very cheap. It was an easy money era. Now, there had been a drop in the stock market. It fell 50%. Corporate profits, I believe, dropped 90% in 1921. A lot of people refer to it as the Forgotten Depression because shortly thereafter, you had the Roaring Twenties kick off. And the Fed was a brand new organization, not a lot of experience with guiding monetary policy, and so they kept rates down at relatively low, and money was cheap and easy. So there was a lot of people borrowing, a lot of people spending. You saw asset prices soar, real estate and stock market, and the speculation only led to more speculation because people thought, hey, it can't go down. Well, the speculation fueled by the easy and cheap money led to a lot of margin. People leveraging their investments. They would borrow money to buy stocks, borrow more money to buy real estate. Does that sound familiar? Well, the Dow Jones multiple, now when we talk about multiple, it's called price to earnings. It's the price of the stock to the amount of earnings. Now, let me redo this. Now we talk about earnings. We're talking about the P multiple, the price to earnings multiple. It's how much is the price of the stock for each dollar of earnings that the company produces. Okay. The Dow Jones multiple reached 19 after increasing 500% of 5 years, right before the Black Thursday. Reached 19. To give you a comparison, currently the Dow Jones multiple is about 7. So you can tell there was an awful lot of speculation going on. Now the current S&P multiple is about 19, which historically is not far off its average. Its average probably is 17 to 20, somewhere in that range. The current S&P average is about 19, which is pretty close to its historical average. It probably will range between 17 and 20. So maybe a little high, but not that far out of the norm right now. Now, Black Thursday, remember the sharp drop that occurred right there at the beginning of the Great Depression. The real Black Thursday, not the Christmas one, but the real one, happened on October 24th, 1929. The Dow opened up the day down 11%, which is a pretty, significant drop. The market had gotten a little queasy in the previous few weeks. And the Dow opened up down 11%, and momentum just built. More people started selling, and it just started picking up steam, and the selling continued. Panic ensued, and the rest is history. Wiped out billions and billions in nominal wealth, corporate and personal. Now, so that kind of kicked off the Great Depression, but making bad things worse, there was almost can I call it a non-comedy of errors? You had the relatively new Federal Reserve that screwed up repeatedly. Now, the Federal Reserve had over the previous decade, the Roaring Twenties, allowed cheap money. Offered cheap money. So you had a lot of speculation. Well, all of a sudden the realization hit them. Money was too cheap. It was too easy. So as the market started falling, the Fed panicked and realized the money supply was too great. So they started hiking rates, which is the exact opposite of what they should have done. They just simply compounded the liquidity difficulties for banks and companies, killing many of them. If you remember after 9/11, a lot of companies canceled contracts, just halted business. I was CFO for a publishing company, and within a week of 9/11, all of our contracts had been canceled. Everybody was scared of what was going to happen. So if the Fed hadn't lowered the interest rates and made money very cheap, you could borrow at almost zero to cover your expenses and get by, then the impact on the economy would have been much, much worse. So in the Great Depression, instead of lowering rates and trying to provide liquidity when it was needed to companies who needed to borrow short term without getting penalized heavily for it, the Fed hiked rates and made it even more impossible and expensive for them to stay in business. That's what we mean when we say, killing liquidity. Now, Hoover, the president, kind of interesting, he increased federal spending 42%. He began public works programs. He hiked taxes, which ultimately further hurt the economy, taking money out of the economy when people already were hard pressed to pay for their bills. He also did something interesting. He banned immigration to prevent an influx of new workers and to try to prevent wages from falling any further, which, is a noble goal. But the practical impact of all this was that it kept prices high, okay, hurting already slammed consumers who had trouble affording things as it was. It worsened poverty. Hoover also implemented price controls. He made allocations of resources impossible with price controls, because if you're a producer, your end product may be price controlled. You can't raise the price, but your inputs may not be. Your labor cost may not be. So as those go up, you simply can't make a profit. So you simply don't produce. You can't afford to produce something and lose money. You won't stay in business. So these price controls worked to make allocation of resources impossible, killed further production of goods, which further killed employment, hurt employment. Also, Hoover signed Smoot-Hawley, which made the Depression even worse. It was a trade protection bill that imposed stiff tariffs on the importation of products. Well, if we're going to penalize countries for, importing goods to this country, they're going to do the same probably, and they did. And so it let off this bout of trade protectionism, and trade died. So Americans basically, bottom line is, Americans couldn't buy or sell foreign goods. And foreign goods are big: agricultural products, parts, those kind of things you just couldn't get, which further hurt the economy, further fueled the Depression. So I find it kind of funny when people say Hoover was a do-nothing president. He did a bunch. Now, it all made the Depression worse, but he's not alone in that regard. Along comes Roosevelt with the New Deal. Now, a lot of the poor and middle class were excited about the New Deal. Huge government spending program and creating public works. Now, remember, Hoover had already started this. Roosevelt just took it and put it on steroids. He expanded really on Hoover's ideas. And Roosevelt also further hiked taxes. Now, one thing Roosevelt did was he began subsidies to farmers. But the nature of these subsidies were that the farmers didn't plant the crop, because the idea is to try to keep prices high by limiting production, or keep the prices profitable for farmers by limiting production. And so farmers, if they receive these subsidies, are basically paid not to plant crops or, harvest their herd. Well, this really hurt food production at a time when Americans were desperate for food. It just was poorly thought out or designed. Roosevelt ended up distorting the marketplace. He hurt business development, killed production, and basically prolonged the suffering and misery. It made the Depression last longer. So, and it's not just a Democratic thing. Hoover was a Republican. Roosevelt was a Democrat. They both pretty much had the same ideas at the time, trying to use government to ease the suffering. And the way they went about it ended up, in both cases, only increasing the suffering and misery. Now, a lot of people think the war ended the Great Depression and didn't actually end it. But what it did end were the government controls on wages and prices, the trade restrictions, and it allowed for increased private investment, particularly when the war ended. Now, one big advantage we had when the war ended was we pretty much bombed the rest of the world. So we were the only country in the world that had production, could produce goods. Our economy rebounded strongly. It took Europe and Russia and others decades before they could get their production back up to some competitive level. So we had huge advantages there. So I hope that helps on, the difference between recession and depression, kind of what contributes to each, what the degree is, kind of how it can impact you. We'll continue exploring the world of investing in finance with the Twitter 8. Let me know what you would like to see. Tune in, subscribe, and my time is up. Thank you for yours.